There's a version of you, 10 years from now, who is either relieved or heartbroken. Relieved because you finally started investing. Heartbroken because you kept waiting for the right time. The truth is, the right time was never some perfect moment in the future. It was always right now. Most people don't fail at investing because they're bad at math or don't understand stocks. They fail because they wait. They overthink. They convince themselves they need more money, more knowledge, or more confidence before they begin. And while they're waiting, time quietly passes. Today, I'm going to show you how to start investing, even if you're a complete beginner, even if you only have $100. Before we talk about stocks, ETFs, or index funds, you need to understand something important. Investing isn't really about money. It's about freedom. Freedom from constantly stressing about bills. Freedom from living paycheck to paycheck. Freedom from feeling trapped in a job you hate because you can't afford to leave. Freedom from working until your body finally gives out. Every single dollar you invest is like a tiny worker you send out into the world. That worker goes to work for you day and night. It doesn't complain, it doesn't get tired, and it doesn't need motivation. Over time, those workers multiply, and that's how real wealth is built. Let's start with one of the simplest and most beginner-friendly tools, ETFs. An ETF, or Exchange Traded Fund, is basically a basket of investments you can buy with one click. Instead of buying a single company, like Apple or Tesla, you buy a collection of hundreds or even thousands of companies at once. That means your risk is spread out. If one company struggles, others can still perform well. ETFs are simple, affordable, and designed for long-term growth. Think of them as a starter pack for investing. They remove a lot of the guesswork and pressure that scares beginners away. Index funds work in a very similar way. They're also baskets of companies, but they're designed to track a specific market index. For example, an S&P 500 index fund follows the 500 largest companies in the United States. A total market index fund tracks nearly the entire stock market. The main difference between index funds and ETFs is how they trade. Index funds typically trade once per day, while ETFs trade throughout the day like regular stocks. For beginners, that difference doesn't really matter. What matters is that both are low cost, diversified, and incredibly powerful over the long term. Now let's talk about one of the most underrated wealth-building tools available, the Roth Individual Retirement Account. A Roth Individual Retirement Account is a retirement account with a huge advantage. You invest money you've already paid taxes on. That money then grows tax-free. And when you withdraw it in retirement, you don't pay taxes on it. That means all of the growth, all of the gains, and all of the compounding happens without the government taking a cut later. If you qualify for a Roth Individual Retirement Account, it's one of the smartest places to start investing, especially if you're young or just beginning. This brings us to the concept that makes investing truly powerful: compound interest. Compound interest is when your money makes money, and then that money makes money, and then that money makes money again. At first, it feels slow, almost boring. You might even wonder if it's working at all. But then something changes. Over time, the growth accelerates. Your money starts growing faster, not because you're investing more, but because compounding is doing the heavy lifting. That's why starting early matters so much. Time is more powerful than the amount you invest. You don't need thousands of dollars to begin. You don't need to be rich. And you definitely don't need to be an expert. If you have $100, you already have enough. One simple option is to put that entire $100 into a broad market ETF, like an S&P 500 ETF or a total market ETF. It's clean, simple, and effective. Another option is a basic split. You could invest 80% into a total market ETF and 20% into an international ETF. This gives you even more diversification across the global market. Or you could open a Roth Individual Retirement Account and invest that $100 into a low-cost index fund inside the account. The exact option matters less than one thing: starting. Dividend investing is another strategy worth understanding. With dividend investing, you buy companies or ETFs that pay you cash just for owning them. Every few months, you receive a payment. You can spend it, save it, or reinvest it to buy even more assets. Dividend investing isn't about getting rich overnight. It's about building a steady stream of income that grows slowly and consistently over time. Here's the truth most people don't like to hear. You will never perfectly time the market. Not you, not me, not even professional investors can do it consistently. What actually works is time in the market. The longer your money stays invested, the more it grows, the more it compounds, the more it works for you while you focus on living your life. You don't need to be perfect. You don't need to know everything. You just need to begin. Your future self is waiting, and they're hoping you don't delay another year. Start with $100. Start with an ETF. Start with a Roth individual retirement account. Start with something. Because the hardest part of investing isn't learning it. It's starting.